can agree. After class lecture, you have to do some revisits of. You have to revisit the taught subject. Okay, just to confirm whether you are seeing the slides. Tim, may you kindly confirm whether you are seeing my slides, please?
Yes, so we can see them.
Great news, great news. As I'm waiting for others, let me just tell you the team. If you're not gonna practice team, let me remind us that if you are not gonna revise, you are not gonna get it, and eventually you may fail. Which I fear that it will be difficult for you to pick up. So the only medicine or the only remedy to this is to revise. That's the only solution. This morning, something like 5 students were with me here, questing for knowledge. They wanted to understand some concepts which they have not comprehended well. So where are you guys? Also, the door is still open for us all. Let's come and revise with me. So this is 11 o'clock. So let's start our lecture. But let me just see quickly. Let me quickly okay, tell me something. Which slide are you seeing? Are you seeing the slide retail redemption of shares?
It's for example to
example 2. Okay, okay. So okay. Let me come here. Okay. Okay, so today I just want to talk about the redemption of shares. Redemption of shares. In my previous slide, I talked about the buyback of shares or repurchase of own shares by the company due to some reasons. I said a company can decide to repurchase its own share if it feels that it has accumulated enough capital, so it will buy its shares back. Now let's talk about redemption of shares. To redeem, it's you are also paying back and buy back the same shares, and you have to pay. And we agreed that the redeemed share may be classified as debt instrument or as equity instrument. And we have also agreed that if it happens that there is dividends on these redeemable shares, we said they are consequently be accounted for as an appropriation of earnings or as a financial cost, depending on how the shares are classified. So in other words, there will be some dividends that accumulate over years, and it depends with the nature of shares, you can actually classify them as finance cost. I talked about that. Very soon we are going to talk about the finance cost. That's the interest. So we appropriate profit accumulated over years or over a period to shareholders. And we normally credit our profit and loss because it's a cost, so it's an expense, so it has a net effect of reducing our profit and loss. Now, in our first slides, we talked about two types of shares. We said there are some shares, especially the preference share, with what you call redeemable preference share and irredeemable. And I think I've indicated to us that the redeemable preference share are those shares that can be repurchased by the company. But irredeemable, we say the fact that in other words, they are not redeemable. But rather they can be converted into ordinary share. Okay, I think respect is important. Let's mute our mics, please. Thank you. So those that are irredeemable, they can only be converted into ordinary shares. That is, if that provision is there in the Articles of Association or even in the Memorandum of Association. So any loss or gain that arises on redemption of shares may also be accounted for in the statement of comprehensive income. So if we happen to have profit or a gain on redemption, we credit income comprehensive income statement. If there is a loss, we debit. So the loss is the reverse. It's a charge. So it's a loss. Or we can actually show this in our statement of changes in equity, depending on how the shares are classified. So if we redeem shares, then we might actually get a gain. Then that gain may be charged against our statement of comprehensive income, or it can be displayed or adjusted in the statement of changes in equity. So, like what I've said, it depends on how we classify the shares. Now, there are two options here. Let me remind us that there are two options. A company can redeem shares at the option of the issuer. In other words, it can redeem those shares at its own option. The company can say, no, we want our shares right now. Or it can be the option of a shareholder. The shareholder wishes to be given his money back. So those are two conditions. One, at the issuer's option, or secondly, at the shareholder. Okay. So when shares are redeemed at the option of the company, there is no obligation of the company to pay shareholders. So the shares are classified as equity instrument. In other words, in this case, if the company decides to redeem shares, then these shares are classified as equity instruments. Now, I want us to understand something. This is the option of the issuer. The company is the one that decides, and the company has no obligation to pay the company's shareholder. So the shares are then classified as equity instruments. So upon redemption, any gain or loss that arises is reported in the statement of changes in equity. Now, I want us to, before, I don't want to confuse us, remember this statement. I said any loss or gain that arises on redemption of shares may also be accounted for in the statement of comprehensive income or in the statement of changes in equity. So it can only be accounted for in the statement of a comprehensive income if it is a what? If it is a shareholder's option, but if it is the currency option, then it will be classified as a statement of changes in equity. That's the statement. Okay, so we just want to do a simple example. This is very, very simple. I'll show you how simple it is. Very, very simple. So we are told that the Tivoko in the Linus Limited statement of financial position comprises of the following. It has the following: redeemable shares. Redeemable shares at $1 per share, 50,000. Share premium, 20,000. Retained earnings, 10,000. The redeemable shares are redeemed at the option of the company. On the same date, the company redeemed and cancelled 4,000 shares at a price of $1.50 per share. Journalize the share premium. So in other words, we want to journalize this. So in other words, remember our redeemable shares, it carries a credit balance. Let me start from here. It carries a credit balance. Share premium, it also carries a credit balance. Then retained earnings, it also carries the credit balance. A credit balance. So if they are all carry credit balance, what therefore it means is that if we debit this account, we reduce. So what in our case, 4,000 shares were 4,000 redeemable shares were redeemed and cancelled. So what we are going to do, we are going to debit what? We are going to debit redeemable shares. Okay. Oh, sorry. We are going to debit redeemable shares. Okay. We debit redeemable shares by. Now we are told that the redeemable share. I want us to understand something here. So it's 4,000 times one puller. Times one puller, 4,000 times one puller, 4,000 times one puller. Just a minute, Heiser. No, one. HOD for accounting.
For I'm doing accounting.
111.
Wait, so I'm doing entrepreneurship and I need to change my.
Oh, sorry. Go ahead. No, yeah. Yeah. Okay, so sorry, Tim. So it's 4,000 times one puller, which gives us 4,000. Someone would ask me what? Hello?
Hello.
Yes.
Sir, may you please come up again concerning the balances? You said redeemable carries a credit balance. Even that part, please come up again.
Okay, I'm saying, remember this part is what we call the equity part. So capital, this is when I say equity, I'm just saying capital part. So capital, remember our ACC 100, it carries a credit balance. So all these capital elements, they carry a what? A credit balance, or this, they have a credit balance. So if they say reduce or redeem, which means we have to debit this. If we are canceling this, we have to debit. That's what I'm simply saying. You get it? Okay, thank you.
No,
Hello?
I think you should make it clear redeemable shares carries a credit balance or a debit balance. That part is the one that I want.
And this is what I said. I said initially these were not there. These ones were not there. So I said, class, you have to know that redeemable shares it's always they do carry a credit balance. Share premium, always they do carry a credit balance. Retained earnings, always they do carry a credit balance. This is what I'm saying. Always they do carry these balances. So if you want, then if I say reduce, okay, I think you are with me. If I say reduce redeemable shares, what do you do? If I say reduce ordinary share, what do you do? You prefer redeemable shares, what do you do? Is that right? Thank you. Yeah,
Debit.
so we debit. So let's go and debit. So this is how we debit. So we are going to say, in this case, we are going to debit our redeemable shares. But what I want us to understand is that these redeemed, the 4,000 that are redeemed, they were originally cost, or their par value is 1 pula. So I'm going to redeem at par value. So these were redeemed at 1 pula 4,000 times 1 pula here. So we get ourselves 4,000 here. 4,000 pula, I will explain. Okay. But how much did we pay in cash? How much did we pay in cash? Tim? How much did we pay for these 4,000 when we redeemed them? How much did we pay them for them? Ketso?
We paid 6,000.
Thank you so much. So we pay, so in other words, we credit our cash. We credit our cash there, 6,000. So now we just want to balance off. Let's balance off. If I'm going to balance this, the difference between the two, it is called the share premium, because you know that the debit side must always balance with the credit. So this is the balancing figure is the 2,000 here, which is the premium. Or you can also do it if you want. You can just say 4,000 times 50. You still get that 2,000. Okay. So we are done. That's the only thing that we have to do here.
Say, Munjay, where did we get the 6,000? Say.
Okay.
And why did we write 4,000 on redeemable?
Yes.
Okay. Now, Tim, I want to ask you something. Do you understand this part, this first part, this one? The highlighted one?
Yes, sir.
So in other words, we are simply saying our shares, so how many shares do we have on this part? How many shares are here? Again, it's 50,000 divided by 1 pooler. So it's 50,000 shares. So we have 50,000 shares here. So it's 50,000 shares. Okay. So, but we are saying of the 50,000, we are canceling 4,000. So we are canceling this with the par value one puller. So this is the reason why I say what we are redeeming 4,000 times one puller. These are the shares that we are canceling. We are canceling these shares. 4,000 times one puller. But they are, when we are paying them, we are now paying the holder at 1+50 instead of one puller. That's so in cash, we are cashing 6,000 here. So I'm now answering also the part here. Where did we get the 6,000? Is 4,000 shares times this times this. Oh, sorry. Times this. Times one plus 50 times 1 plus 50. This is how we get our 6,000. So I want us to note the difference. Okay, let me do this. I think for our understanding, let me do this. Suppose you have a car that has an original value of 50,000. Then you sell it at 70,000. Now you want to tell someone that you sold a car. Did you say you sold a car which was 70,000, or else you say I sold a car which I bought for 50,000 at 70,000? That's what you say. So in our case, we are saying we are redeeming 4,000 shares, but these 4,000 shares originally their par value is one puller, but we are redeeming them at 1 puller 50. 1 puller 50. So in other words, we are saying the redeemable shares is equals to 4,000 times 1 puller, which will give us 4,000 puller here, which will give us 4,000 puller. But we are going to what? To pay, because when we redeem, we are paying. So we are going to pay shareholders. How much? We are going to pay them 4,000. The 6,000 rather. We're going to pay them 6,000. Okay. So to complete our entry, we have to debit redeemable shares. Then we are going to credit our cash, like what my brother said. We credit our cash by 6,000. 6,000. The difference now, because these two sides, the debit side and credit side, they must be balanced. It goes to what we call share premium. Share premium. In other words, they were overcharged. We pay more than their original value. Their original value was 4,000. So in other words, under normal circumstances, we're supposed to, okay, listen, team. I want you to listen to this here. Under normal circumstances, what we're supposed to do, we're supposed to say, when we redeem, we're supposed to redeem them at 4,000 here. Because they pay 4,000, so I must give them 4,000. But in this case, this is not what we do. What we did here, we paid 1 puller 50 instead of 1 puller, which means we paid more. So the difference between 6,000 and 4,000 is what we call a share premium. That's the share premium. Okay. So let me just try to test your understanding. Let me try to test your understanding here. Let me try to test your understanding. Just briefly, I want to see whether I'm with someone here. Yeah, put 10,000 here. Okay. Yeah, I'll give you something like here. 5 minutes. Can you do the journal entries for the redemption of shares quickly, please? Welcome back. Anyone who wanted to give a trial, just tell us what we are supposed to do. Anyone, please?
Sir, I'm
Yeah.
not sure.
Okay, it's okay. You can go ahead.
But I think we debit the redeemable share.
So we debit redeemable shares.
10,000.
Okay, so he said 10,000 times 1 dollar here. Okay, so 10,000.
And then the share premium is going to be 5,000.
Okay, so share premium is 5,000. Yeah, share premium.
And then the last one is
Share premium. Okay, you said for share premium is it's how much?
5,000.
Because you say times 0.50. Okay, then you get yourself 5K. Okay.
And then the cash out, I would have credited it by 15,000.
15K. Very good. That's it. Thank you. Thank you. Thank you so much. I think that's it. That's it. Thank you. You nailed it. So let's move on. And you have to exercise this. Let's see something here. I want us to try the last one. Sorry, the last one. Sorry. Can you also try this one? let's just try this one. I'll also give you something like 3 minutes. It's faster. Zebra Limited statement of financial position had, among others, the following balances on 31 July 2024. Stated capital 40,000 shares, 60,000. Retained earnings 20,000. The shares are redeemable at the option of the company. On 1 August 2024, the company redeemed and cancelled 4,000 shares at 2 pula per share. So here you show journal entries, So we want journal entries here. Okay, I'll give you something like 3 minutes, please, to finish that one because it's easy. Okay, yeah, someone just to give us an answer, please. Someone?
So we're going to debit redeemable shares with 6,000.
Redeemable shares.
Mhm.
Can you explain why we are debiting that 6,000 redeemable shares?
Oh, it's
Here, it's not redeemable, it's stated capital. We have to show what is the yes.
okay. Thank you.
Mm.
We say what we need to first find the price per share.
Okay,
Then the price per share.
okay, so let me create a space here. So this is your working. So you said you are trying to establish price per share.
Mm-hmm.
Oh, sorry, yeah. Okay.
So to get our
price per share.
We said the 60,000, which is the total price, divided by 40,000 shares.
Divided by 40,000 shares. Okay.
To get 1 pula 50 per share.
1 pula 50. Thank you. Okay.
Okay, and then we debit stated capital by
stated capital.
6,000. It's 4,000 times 1.5.
So
4,000
times 1 pula 50. Okay. We get ourselves 1,000.
Yes, and then the share premium would be 4,000 times the 0.5.
No, explain that.
Oh, okay, no, so let me start with crediting cash. You credit
no,
cash.
No, it's fine. No, it's still fine this way.
I don't know how to explain.
But I want you to explain because you just say times 0.5. Where are we getting that 0.5? That's my question.
The difference between the price that they redeemed at and the original price, the par
Yeah,
value.
the power value minus that's 1 plus 50. Thank you. 1 plus 50.
Yes.
You can go ahead.
So then that is 2,000 pula.
Yes, sir. So I think you're messaging. I didn't get that. Yeah, it's really black. I was asking if you can write a reference for me. Wow, if you apply for transaction.
Okay, so do you mind if you can come after this lecture?
Okay.
Or you can write it, then I will put it on the letter. Write it the way you want it. That's the fact.
Okay, thank you.
Oh, sure. Okay, you can go ahead. Sorry, madam. You can go ahead. So you say 2 pula minus 1 pula 50.
Mm-hmm.
Then you say time is our 4,000 there.
Yes.
That will bring us
2,000 pula.
2,000 pula 2K. Okay.
Mm-hmm. And then you credit cash
So
4,000 times the redeemable value, which is 2 pula.
okay, 4,000 times 2 pula. Great.
Yes.
Then we get ourselves 8,000.
Yes.
Yeah, that's simple. No, thank you. Thank you.
You're
Thank
welcome.
you. Hello? Okay, thank you. So let's move. That's beautiful. Let's talk about this one now. This one. So we said the first one is the option of the the company. Now the option of the shareholder. We just want to see how shares. How do we go about in this scenario? So you'd find out that the difference is the same. There's no difference here in terms of how we classify these ones, but now these ones they are classified as either comprehensive income or statement of changes, also depending on how we have classified. So allow me to go straight to this. This is very important. This is what you have to know. So if this is the, we said shareholder option. So in other words, it's the shareholder who would say, can you redeem my shares? So this is the double entry. So shares redeemed at a premium. What we know, we have to debit redeemable shares. We debit loss on redemption. We credit unsecured payables. Let's understand these terms now. So if shares are redeemed at a premium, what we do, we debit redeemable shares. We also debit loss on redemption. We credit unsecured payables. We credit unsecured payable. If shares are redeemed at a discount, in other words, at a lower price, what do? We debit redeemable shares. We credit unsecured payables. We credit gain on redemption. So where is this gain coming from? The gain is actually coming from the fact that instead of paying more, we actually like paying just a small amount. Instead of paying 2 pula per share, maybe we're now paying 1 pula per share. So automatically it's a gain on our side. So what do we do? When there is a gain, it has a net effect on our statement of comprehensive income. It also have a net effect on our equity, changes of equity, statement of changes in equity. But however, this you have to know, or even to sing, share redeemed at a premium. What should you do? You debit redeemable shares, you debit loss on redemption, you also credit unsecured payables. Now, why are there's no cash here? I want us to see that there is no cash here. But what is there is that we are, those are now what we call debt instrument. Those are debt instrument. In other words, we are obligated to pay this person. The first one was equity instrument, but this one is now a debt. We are not going, because you decide to redeem them, but us, we don't have money to pay you now, so we just reserve them as unsecured payable. And remember, the payable, it means it's a liability, so we have to pay in the future. This you have to know. Okay, so let's try an example now. Swana Limited statement of financial position has, among others, the following balances on 31 June 2024. Stated capital 50,000 shares, 50,000. Retained earnings 60,000. Redeemable shares 10,000 shares, 40,000. Bank loan 10,000. On 1 August 2024, the redeemable share opted to redeem half of outstanding shares at 2.50 each. Journalize this. So we are making some journal entries on this. So we want to, can someone try, let me just give you something like 2 minutes rather, to try to do something. I think we'll be in a position to do something. That will be fine. Let's just do, bearing in mind these formulas to say share redeemed at a premium, redeem what we have to conceptualize this. Then we apply it here. Okay, can someone just give it a try, please? Any taker, please? Okay, let me try to demonstrate. So here we said what we're gonna do, we have to debit the redeemable share, because we have been told that it's it decided to redeem the half of the outstanding shares. I think it's the wrong number. Okay, sure. So what I'm saying here, we are going to redeem redeemable shares here. Redeemable shares here. Okay. So we debit the redeemable share, and we are told half of this. So half of this 10,000. So half is 5,000. But now, like what my sister said, let me just create a space here. So she said the first point, we have to working for price per share, per value per share, per value per share, per redeemable shares. Okay. like this. Very good. So what we're gonna do, ladies and gentlemen, we're going to say par value per share is equals to, here we are told that the redeemable ones is 40,000 here. This is the one that we are talking about. It's 40,000. So we are going to say here, we are going to say here, 40,000 divided by 10,000. So here is equals to 4 pula per share. Okay. Per share. Okay. So in our case, we are going to debit now the redeemable. So, okay, sorry. So number of shares that we have, number of shares of redeemable shares is 10,000. So half of it is going to be redeemed. So what is half? So 10,000 divided by 2 is gonna give us 5,000. So half 5,000 is redeemed. 5,000 redeemed. Okay. I'm just doing my workings here. So here, redeemable shares 5,000. That's the half times 4. Okay. Which is going to give us 20K. Okay. Now, but here we are told that these shares, they are going to be redeemed at, what? What do you call it? At a discount, because there's a discount here. You see, they are redeemed at 2 pula. So remember what we said. So here we are going to credit. Payable, unsecured payable of how much? Unsecured payable of how much? Tim, we said it's unsecured payable of how much? 2 pula 50 times 5,000. What do we get? 2 plus 50 times 5,000, it gives us how much? Tim?
12.5.
Okay, thank you. So 12,500, we credit here. So I'm also going to, if you want, but we can still prove it. But if I don't want to do to work, I can simply say 20,000 minus 12,500. I can still do that and still get the answer. But if you want to follow the process, we are saying we have to credit gain here, gain on redemption. So there's a gain on redemption where we are going to say 2 pula 50, 4. In other words, the shares they bought these shares at 4 pula, but we are redeeming them at 2 pula. So it is, we are gaining 1 pula 50. So if I'm going to say 1 pula 50 times 5,000 here, what do we get? What do we get, Tim? In my case, according to my workings here, I'm getting 7,500.
Yes.
7.5. Yeah, that's it. Hello? I think it's the wrong number, sir. Yes, sir. Yes, I'm fine. How's it? Don't know. This is the 9th time that I'm receiving calls from you. Yeah, I don't know. So I don't know if I want to report this, where should I go? Thank you so much, sir. Sure. Okay, so that's it. So in the remaining few minutes, please, I want. Okay, is it a hand? Okay, you can go ahead. Okay, so this is your take home, ladies and gentlemen. I want us to do this as we are going to raised, but I think this is one of the easiest topic. So the following balance appeared in the general ledger of Kwena at 30 September 2023. Share capital 50,000, share premium 2,000, retained earnings 40,000, 10% redeemable shares 10,000. On 31 December 2,000 shares were redeemed at $1.50. The dividends on preference had not been accrued. I want us to understand, Tim, before you go, can someone just interpret? Can someone explain what we are? The one who said he wanted to be added on group. I think we circulated a link. You can also you can liaise with your colleagues. I'm going to send it in the group right away, the group link. But can someone just explain to us what this question, the demands of these questions? What is it that we are required to do? Tim? Tim? Integra, please. Guys, no, let's help each other here. That's learning. We must not be the listeners. We must actually participate, guys. Let's hear from you guys. Ketso, you can go ahead. Say something, Ketso Mahla. Okay, and Tato Haisina. Tato.
Yes, sir.
Can you try to interpret what is on the question?
Okay. I think we have to do the journals to show the dividends on preference shares, and
Good.
then also for the redemption. And then for redemption, you're supposed to take note that the shares are redeemable at the option of the company, which is different from when the shares are redeemable from at the option of the shareholder. And at the option of the shareholder, you have to also make sure that you take note whether they're redeemed at a premium or at a discount. And then also you're going to do the shares are redeemable at maturity.
What does that mean?
That one I don't know.
Are you not mature? Are you not mature? So from that word of maturity, what does that mean?
I don't know. It means that when the time that it had been given for it has elapsed.
Yes. Yeah. So in other words, when the time that it has been like given elapse or mature. So for example, if I say this is a 10-year, so now we have reached the 10 years, then we have to redeem.
Yes.
So there is no option here. So what do we do on that one? Because it's actually different from when you are redeeming at an option of a company or at your own option. What do you do? So those are the questions that we want us to work on. So in the interest of time, may I release you for another class? But before that, Tim, make sure that you revise. It's in this module, like what I've said in the very beginning, many people fail this module. Many. If you check, I want us to understand something. I'm sorry to say this, but I have also to motivate you so that, guys, you might think that out of the 400 students that are currently on board, 150 are repeating this module. About 150 they are retaking this module, which is a sign that it's not easy. And you cannot actually, yeah, it's true, Tato, it's true. 150 are repeating. So it's easy to fail this man. With this small statement that we are doing, a person can fail. So for us to safeguard, let's practice. As many, I give you questions. There are also past exam papers on Teams. Please practice those ones. Where you are stuck, your door 218 is your office. You always come for some consultation or time in the game. Okay, you can go ahead, Nozuelo. Tifilwa. Okay, thank you. Yes, you can go ahead. Nozuelo. I don't know. Anyway.
Hello, sir.
Okay,
Hi,
go
sir.
ahead. Go ahead.
I was asking that can I be added on Teams, sir?
Okay, where are you? Are you on campus or are you away?
I'm on campus, sir.
218, just dish.
All right, ma'am.
Thank you. So signing out anyway, enjoy your day, guys. See you on Friday, but I'm always available. Bye. Thank you.